You are about to gift the ATO a brand new luxury car and you don't even know it. And the worst part is that it is perfectly legal for them to take it if you stay silent. If you are over 45 and your super balance is sitting north of $300,000, you are currently the ATO's favourite type of Australian. You are the silent donor. The one who works 60 hours a week just to hand over nearly half of every extra dollar earned to the taxman. But the clock is ticking. We are in the final countdown to the 30th of June. And if you do not act before the sun sets on this financial year, the $12,450 saving is gone forever. It won't roll over, it won't wait for you, it simply evaporates into the government's coffers. Welcome to Aussie Super Secrets. Today, I'm going to reveal the exact tactical blueprint to claw back your wealth and supercharge your retirement balance using the 2026 rules. We are talking about institutional-grade tax minimization that the big retail funds won't tell you about because they're too busy collecting your management fees. By the end of this video, I will reveal a hidden catch in the transfer balance cap. That could cost you 6 figures in future tax-free earnings if you mistime your contributions today. You cannot afford to miss this. But before we dive into the deep end, we must address the legalities. This is general information only and does not constitute personal financial, taxation, or legal advice. Every person's situation is unique, so you should seek independent advice from a qualified professional, such as a licensed financial advisor or accountant, before making any investment decisions. Now, let's talk about the $30,000 golden ticket. For the 2025 to 26 financial year, the concessional contribution cap has been indexed to $30,000. This is your most powerful weapon. If you are earning over $190,000, you are in the top marginal tax bracket of 45%, plus the 2% Medicare levy. That means for every dollar you earn above that threshold, you only keep 53 cents. It's madness. However, when you make a concessional contribution to a fund like Australian Super or ART, that money is generally taxed at only 15% inside the fund. You are effectively swapping a 47% tax rate for a 15% one. That is a 32% instant return on your money before you've even picked an investment option. If you maximize that $30,000 cap through salary sacrifice or personal deductible contributions, the tax saving alone is staggering. But do you know the absolute worst thing the ATO can do to you if you get the timing wrong? We'll see that in a second, because there is a trap waiting for you in the banking system. It is called the BPAY death trap. Listen closely because this ruins thousands of tax returns every single year. Most Australians think that if they hit send on their bank transfer on the 30th of June, they are safe. Wrong. For a contribution to be deductible in this financial year, the cash must be received and cleared by your industry or retail fund by the 30th of June. If you use BPAY or EFT on the 29th of June, and there is a weekend or a banking delay, your money might not land until the 2nd of July. If that happens, you lose the deduction for this year, and you've accidentally used up your cap for next year. It is a total disaster for your cash flow. I tell my private clients that the 23rd of June is the absolute drop-dead date to initiate transfers. Don't let a slow banking server cost you $12,000 in tax offsets. But what if you have more than $30,000 you want to protect? This is where the catch-up or carry-forward rules come into play. If your total superannuation balance, or TSB, was under $500,000 on the 30th of June of last year, you can reach back and use the unused portions of your concessional caps from the last 5 years. This is how high-net-worth individuals make massive, one-off contributions of $50,000 or even $100,000 in a single year to offset a large capital gain or a massive bonus. Imagine Sarah. Sarah sold an investment property and is looking at a massive capital gains tax bill. By using her carry-forward concessional caps, she wipes out the tax on her gain and moves that wealth into the low-tax environment of her super fund in one move. It is the ultimate legal tax shield. But wait, there is a shark in the water for those earning over $250,000. It's called Division 293. If your combined income and super contributions exceed $250,000, the ATO hits you with an additional 15% tax on your contributions. Even with Division 293, you are still paying 30% total tax inside super versus 47% outside. It is still a win, but you must account for that bill when it arrives 6 months later. Don't let it surprise you. Many people forget to tick the box to have their super fund pay the Division 293 bill, and they end up scrambling for cash. Are you really going to let the ATO keep your hard-earned wealth just because you didn't fill out a form? Before we get to the climax and the secret of the transfer balance cap, remember that keeping your fees low is just as important as saving tax. If you are in a default My Super option with a high balance, you might be paying thousands in asset-based administration fees. Check if your fund has an admin fee cap. Many large industry funds cap their administration fees once your balance hits a certain level, but you often have to move out of the default My Super option and into a choice or member direct investment strategy to truly optimize the cost. Do you feel the weight of the money you've been leaving on the table? It's time to stop the bleed. This is general information only and does not constitute personal financial, taxation, or legal advice. Always consult a pro before you move your millions. Now, for the climax. The biggest secret of 2026 is the interaction between your contributions today and the transfer balance cap in the future. The transfer balance cap limits how much you can move into the tax-free pension phase when you retire. Currently, that cap is $1.9 million. If you wait until you are 60 to try and dump money into super, you will hit the non-concessional limits and the transfer balance cap will lock you out. By maximizing your concessional contributions now, while you are in your peak earning years, you are using before-tax dollars to grow a balance that will eventually produce tax-free income. The compounding effect of that $12,450 tax saving alone, invested inside a high-growth option over 10 years, could mean an extra $30,000 in your pocket at retirement. That is the difference between a modest retirement and a first-class one. If you are ready to stop being the ATO's favorite donor and start building real, protected wealth, you need to stay ahead of the game. Our next episode drops this Thursday at 7 p.m., where we will be exposing the hidden fees in retail funds that are eating your retirement for breakfast. You won't want to miss that one. Make sure you hit the subscribe button for Aussie Super Secrets right now and click the bell icon so you never miss a tactical update. Secure your 2026 tax saving today, because on the 1st of July, it's too late. See you in the next one. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.